Hi, this is Dan Joseph of the China Learning Curve. Welcome to our video newsletter for May 2015. The economy gets weaker, liberalization gets stronger, the stock market soars higher, and the showdown in the South China Sea gets testier. Those are the main stories this month. As always, our newsletter focuses first and foremost on three areas: the economy, economic liberalization, and law and politics, all with an eye toward what matters most to foreign businesses. For this video report, we'll start with the economy. Fixed asset investment grew at its slowest rate in 14 years, and industrial production grew at its slowest rate in 7 years. Those are just the highlights from the most recent set of economic indicators, all of which sound the same note: China's economy is slowing. Of course, that's been the case for months, and as many people have said, that isn't necessarily a reason for panic. China's ultra-high growth of the past is unsustainable, and adjusting to a new normal is natural. But as China's economy seems to continue to decelerate, concern is growing that, instead of adjusting to a new normal, the economy might fall into a slump that will have a significant impact on employment and from which recovery will be challenging. China in May implemented another minor stimulatory measure, a small interest rate cut, but like the other 5 times they have made a similar move over the last 6 months, this one is unlikely to stir much economic activity. The big question is, will China resort to heavy government spending to stimulate the economy, which will increase China's already high debt to GDP level? Based on some rule changes China made relative to local government borrowing in May, it seems China is considering that option. As we've been saying all year, the central question for China's economy is how the government will balance debt with growth this year. So far, prudence has been the guiding principle for China, and we haven't seen an acceleration in debt creation. That could change, and it isn't clear that that would be good for China. This issue, debt versus growth, remains one of the most important issues to watch relative to China, and we'll keep our eye on. On the brighter side, in May, China took a number of steps that seem to indicate that China remains committed to free market liberalization, which would be very good news for China's long-term growth and development. For example, price controls on a bunch of products, including many drugs and pharmaceuticals, are to be lifted. Small steps toward capital market liberalization were also made, and perhaps more importantly, a plan for greater liberalization over the next few years was announced. Lastly, China announced it is adopting IMF standards relative to balance of payments accounting. China is doing this because it wants its currency, the RMB, to be included as a reserve currency by the IMF, and it knows it has to comply with IMF standards to be an IMF reserve currency. Now, this is both a good step toward the free market and also an example of how integrating with the global economy and joining international institutions has the effect of incentivizing China to comply with global standards. With all the challenges China faces and all the turbulence that seems to surround the country recently, it is encouraging to note that on this important point, perhaps the most important issue facing China today, the government seems committed to the right course of action. That is, continuing the transition from centrally planned communism to free market-oriented capitalism. While the preceding stories, economic performance and liberalization, are likely the most important topics in China today, the stories that got the most attention in May relate to 2 things that are rising unexpectedly: China's stock market and tensions in the South China Sea. Let's start with tensions in the South China Sea. As we have pointed out in earlier newsletters, China began to more aggressively expand its presence in disputed territories of the South China Sea in 2014. There was a pause toward the end of last year, but recently China has increased its activities again. In May, after China took actions including apparently installing military equipment in some of these outposts, the U.S. began challenging China's intentions by placing military aircraft and vessels closer to the disputed territories than China wants. In other words, flying and sailing where China doesn't want anyone to fly or sail. Verbal confrontation ensued, including both sides asserting that they have no intention of backing down. Some of the rhetoric became fairly heated. At a security conference in Singapore at the end of the month, both sides struck a more conciliatory tone, giving reason to hope that cooler heads will prevail. But the fact remains that the possibility for an escalation in tensions remains strong. Both sides have an interest, primarily an economic one, in avoiding confrontation and maintaining stability and cooperative relations. But the fact is, at least from a defensive point of view, the allies actually aren't that important. They aren't really defensible unless you surround them with heavily fortified naval vessels. But China seems intent on controlling air and naval traffic in that area. Its neighbors don't like that idea, and neither does the U.S. It's not clear where this issue will go next, but it definitely deserves our attention. Lastly, we have China's stock market, which was making all kinds of headlines in May. Despite weakness in China's economy, its stock market is soaring, up roughly 140% over the last 12 months. While there is a good argument to be made that the long-term prospects for China's economy remain strong, there's an even better argument to be made that China's soaring market has more to do with capital controls, excess liquidity, and increasing leverage in China than the performance of its companies or its economy over the short or long term. As you assess China's stock market, we suggest you consider the following points. First, China's capital markets are less developed, less mature than those in America or other developed countries. While most trading in the U.S. is done by institutional investors, in China it is the retail investor who dominates the market. Businessmen, taxi drivers, grandma students, the common man from every walk of life. Secondly, leverage in China's stock market has exploded. Margin buying has quadrupled in China in the past year. That's right, I said quadrupled. One of the reasons China has had trouble stimulating the real economy is that excess liquidity is simply going into the stock market, not the real economy, which is probably not good for either. Thirdly, turnover, which means how quickly people sell stocks that they've bought, has also exploded in China, up six-fold in Shanghai and 350% in the Shenzhen market. And in those markets, it's more than twice as high as in the U.S. Lastly, valuations are high in China. Stocks in the Shenzhen market are trading at an average of 61 times earnings. In the larger Shanghai market, half of the stocks have a price-earnings ratio of more than 40. This compares with an average PE ratio of 22 in the United States. So make up your own mind. Maybe China's soaring market is completely rational. Then again, if you take the preceding points together, maybe what we have is fairly unsophisticated investors using a whole bunch of borrowed money to trade stocks as fast as they can at any price that's available. Now, that's not exactly the safest market in the world. For more detail on these stories, please see the written newsletter on our website. The written newsletter also has some additional stories, including our Law and Politics section, which has a few items relative to intellectual property protection. That's it for this month's video newsletter. As we like to say, give us 15 minutes per month, and we'll keep you up to date on China. This is Dan Joseph for the China Learning Curve. Thanks for watching.